Let's go over this week's information. Yep, we're still in the market. We're still making money. In my spare time, I play a little chess too. Okay, our mystery trader continues to get nervous because the VIX continues to go down, but he's got till September to make his fortune, so we'll keep an eye on him. Looking at our sectors over the last year, 2 points. The KRE, which is the regional banks, they continue to recover. And we have quite a number of our sectors now improving. So that's pretty good news. It looks like the market's not in for any surprises soon, barring, a war popping up somewhere. And we see that our new portfolio too, the green line, is doing quite well. We look at the detail of that. SVIX, which is short the VIX, is really up there, 67%. Cane sugar starting to come right back again. It's fairly volatile. And then Dow Jones, the Japanese yen is doing good. It's hedged, this particular thing. And then consumer staples, very steady. Just this may increase with time to lend a little more stability to an exciting portfolio. Okay, DXJ, Japanese hedged equity. Some Japanese stocks, and then hedged against fluctuation of the yen to the dollar. IYK, consumer staples. Our long term is still sitting there, making over 21% a year. And it's been out for quite some time, and there's nothing happening that would bring this long-term timer back into the market just yet. It's the same formula, but we reanalyze with the time frame starting in 2006 and allow the computer to pick the buy and sell points and re-optimize for since 2006. And we have a over 19% a year return and only a 12%, almost 13% drawdown, which is a spectacular formula. And it's not in any danger right now of triggering. We're still on a good, strong buy. We're going to do a quick review of our second best formula in the whole world, which is way better than most people have. And that's to look at this weird thing called the NDX percent moving average 200. The NDX is the NASDAQ 100. And we're looking at the percent of stocks in the NASDAQ 100 that are above their 200-day moving average. Okay, this is going to run between 100%, it's not going to get better than 100%, or zero. So somewhere between 0 and 100% of the stocks are above their 200-day moving average. And here's the actual data, and this data is kept carefully not by going backwards in time from what's in the NASDAQ right now, but this is collected over what was in the NASDAQ back in this time frame, because those 100 stocks, a lot of them drop out and then others come in. So you have to have the storage of your data to be able to create this look back. Anyway, the whole thing is is this a good thing to look at? Yes, it is. When the stocks in the NASDAQ, the percent of them that are better than their 200-day moving average start to drop, well, the stock prices are going to drop too. And they drop in advance of the stock market crashing. So you have a good warning. They also show a dramatic jump coming from, almost zero. When the trouble is over and they start back up, that is a safe time to come into the market. And you see where that comes in. That's just fantastic timing. It turns out that for predicting the end of a crash, this thing it's hard for anything to beat it. And what makes this good, there's no lag. There's no lag on it at all. We do a little bit of smoothing with an exponential average, but basically when your stocks drop below 57%, this triggers a sell. Now, if it never got to 57 and turned around and started to go down, you also have a sell at 42%. And when the real crash takes place, they drop down below 12%. And so the minute that they come back up over 12%, that's a buy. So you'd keep back in right here. Well, if it dropped down here with a sell and then comes up past 54%, that's a buy. So we have two levels where we can buy and two levels where we can sell. The computer goes and moves these around and says, here's what happens. And this will usually be good for 6-7 months at a time before you have to go look and re-optimize. If you never re-optimize, you still have a good formula. You would not miss a crash and you would not miss a recovery. It simply fine-tunes the more years you add to it. And this is what it looks like, what it produces. So you see the green line is when we're in the market, out of the market, the money we've created versus the buy and hold. So where the buy and hold averaged 13.6% with a 53% drawdown, this formula made 18% with a 14% drawdown. Now that's second best to our other formula, but it's way, way better than any almost 98, 99% of all other advisors don't have a market timer that's this good at all. Looking at the stocks and the mutual funds that the typical 401ks have. By the way, if you're in a 401k where you don't have any of these and you want any information, just send me an email with what you have in your 401k for choices, and we'll add it to our list and keep track of it for you. The only thing I'm pointing out here is that there's nothing new here. They're all good. And COMEX is coming up making good money. This is a 1-month look back. But our other mutual fund, the OIEJX, now is making over 4.5%. It's come back roaring now. And so those people have usually been not doing so good. It's been down here more like the commodities, but now that's recovering and making good money. So everybody ought to be happy in their 401ks now, making money. And it just looks like we've got good information. Should be good for another couple of weeks. No problems. No changes in our portfolios. No changes. For timing signals, we still have that 100% buy on the average true range, which is our best formula, and the 200-day moving average percent above 200-day for the NASDAQ 100 is also a buy, and we're in 100% still. So you see the Russell 1000, it is continuing to improve. The S&P 500 continuing to improve. the QQQ continuing to improve. A little bit of a blow up on that. You know, we've added buy and sell signals on our QQQ that you haven't seen before. I've had a simplified picture of them so that it looked nice, but here's the actual formula where we have buy and sell. And we have the added yellow line at 70%, where if you get above 70, you can start to drop some of the hedging. And now we are sticking our head up over 80, and we've dropped all hedging. That's why we dropped the VIXM from our formula for our portfolio. So that's our percent above 200. And our volatility is measured off the average true range, which is a price movement on the actual equity. Again, there's no lag on that either. And it's not tied to the typical volatility like the VIX, where now there are people that are wondering if the VIX is going to still be predictive with different instruments that have been added for even shorter term VIX, and a lot of investors switching over to them instead of the 1 month time frame VIX. It doesn't bother me because I don't use that now. I found something better, and that was the volatility created by the movement of the NASDAQ itself. Just its own price movement is enough to create a volatility curve that works perfect.